Investing in rental properties can be a great way to build wealth. It offers a steady stream of income and the potential for long-term appreciation, but it's crucial to analyze potential deals carefully. Without proper analysis, you could end up with a property that drains your finances instead of boosting them. A thorough analysis helps you make smart decisions and maximize profits. It involves looking at various factors such as location, market trends, and property condition. This guide will give you the tools to analyze rental properties like a pro. You'll learn how to evaluate properties, calculate potential returns, and identify red flags. Analyzing a property means understanding its potential for profit. This includes estimating rental income, considering expenses, and assessing the overall investment. You need to know if it will generate positive cash flow. Positive cash flow ensures that your investment is sustainable and profitable in the long run. You need to be able to calculate your return on investment. ROI helps you understand the profitability of your investment compared to other opportunities. With the right knowledge, you can confidently choose properties that fit your goals. Whether you're looking for short-term gains or long-term stability, informed decisions are key. This guide will cover key metrics, methods, and tools for analyzing rental properties. You'll gain insights into market analysis, financial calculations, and risk assessment. We'll look at real-world examples and offer tips for success. These examples will help you understand how to apply the concepts in practical scenarios. Whether you are a beginner or have some experience, this guide has something for you. It will equip you with the knowledge and confidence to make informed investment decisions. To analyze a rental property effectively, you need to understand key profitability metrics. These metrics are essential tools that provide a comprehensive view of the property's financial health and potential for generating income. These metrics help you evaluate the financial performance of a property, allowing you to make informed investment decisions. By understanding these numbers, you can gauge whether a property is a good investment or if it might be a financial burden. Cash flow is the lifeblood of any rental property. It represents the money that flows in and out of the property, and it's crucial for maintaining the property's financial stability. It's the money left over after you pay all expenses, including mortgage payments, maintenance costs, and other operational expenses. Ensuring positive cash flow is vital for the long-term success of your investment. Positive cash flow means the property generates more income than it costs to operate. This surplus can be reinvested into the property or used to expand your real estate portfolio. The capitalization rate, or cap rate, is a measure of a property's potential return on investment. It helps investors compare the profitability of different properties. It's calculated by dividing the property's net operating income by its market value. A higher cap rate indicates a potentially more profitable investment. Cash-on-cash return tells you the return on your actual cash invested. This metric is particularly useful for evaluating the efficiency of your investment. It considers your down payment, closing costs, and any rehab expenses. By understanding these costs, you can better assess the true profitability of your investment. A higher cash-on-cash return means a more profitable investment. This metric helps you identify properties that will provide the best return on your cash outlay. The gross rent multiplier is a quick way to assess the price-to-rent ratio of a property. It provides a snapshot of how long it will take for the property to pay for itself through rental income. It's calculated by dividing the property's market value by its gross annual rental income. This metric helps investors quickly compare different properties and make informed decisions. Before you can analyze a property's profitability, you need to determine its market value. This is a crucial step in real estate investment. The market value is essentially the price a willing buyer would pay for the property in a competitive market. To determine this, a comparative market analysis, or CMA, is often used. This involves comparing the subject property to similar properties that have recently sold in the same area. By analyzing these comparable properties, you can estimate the fair market value of the property you are interested in. This helps you make informed decisions. Another method to determine market value is the income approach. This method uses the property's potential income to estimate its value. The income approach is particularly useful for income-producing properties like rental units or commercial spaces. It considers factors such as rental rates, vacancy rates, and operating expenses to determine the property's value. One quick rule of thumb for evaluating the rent-to-price ratio of a property is the 1% rule. This rule suggests that the monthly rent should be at least 1% of the purchase price. For example, if a property costs $200,000, the monthly rent should be at least $2,000. By using these methods, you can accurately determine the market value of a property and make better investment decisions. Section 4. Calculating ownership costs. Owning a rental property comes with various expenses. Accurately calculating these costs is essential for determining profitability. The 50% rule is a simplified method for estimating operating expenses. It suggests that operating expenses will be about 50% of the rental income. While this rule provides a rough estimate, a detailed analysis is recommended for more accurate figures. This method involves itemizing individual expense categories. These include property taxes, insurance, maintenance, repairs, property management fees, and vacancy rates. Accurately estimating expenses helps you avoid unpleasant surprises and ensures you are making informed investment decisions. Section 5. Tools and resources. Several tools and resources are available to help you analyze rental properties efficiently. Online rental property calculators simplify calculations and provide a comprehensive analysis of profitability, cash flow, and return on investment. They take the guesswork out of analyzing properties. Spreadsheets allow for detailed tracking and customization of financial data. You can find free rental property analysis spreadsheet templates online or create your own. These tools help you organize data, calculate metrics, and make informed decisions about your rental property investments. Section 6. Real-world example. Let's look at a real-world example to illustrate property analysis. Property, 3-bedroom, 2-bathroom house. Purchase price, $250,000. Down payment, $50,000. Monthly rent, $2,000. Operating expenses, estimated, $800 per month. Using a rental property calculator, we can input this information to determine the property's profitability. The calculator would factor in metrics like cash flow, cap rate, cash-on-cash return, and more. This analysis would help you decide if the property meets your investment criteria. Section 7. Tips for successful analysis. Here are some tips for successful rental property analysis. Use reliable data for property information, expenses, and rental rates to ensure your analysis is based on realistic figures. Overestimate expenses and underestimate income to account for unexpected costs and ensure a buffer for profitability. Conduct thorough research and property inspections before making an offer to avoid potential pitfalls and ensure the investment is sound. By following these tips and utilizing the tools and strategies discussed, you can make informed investment decisions and set yourself up for success in the exciting world of rental properties.